Hey, have you ever noticed how the market sometimes acts completely insane on Fridays? Stocks randomly reverse, breakouts fail, markets get pulled towards strange prices, and suddenly everything becomes wildly volatile in the last hour. Most retail traders think it's news, but Wall Street knows something different. There's actually a hidden force controlling huge parts of the market, and it's called options expiration. Today I'm going to show you why stocks get magnetized to certain prices, how market makers secretly move markets through hedging, what gamma really is, and why billions of dollars can suddenly flood in or out of stocks during OpEx. Once you understand this, you'll never look at the stock market the same way again. Every month, millions of option contracts expire. And when that happens, market makers, hedge funds, and institutions are forced to adjust massive hedge positions. This creates artificial buying and selling pressure that can completely distort normal market behavior. That's why on OpEx days, stocks pin to certain prices, volatility suddenly explodes, and markets often make fake moves. To understand why this happens, we first need to understand one thing: how options dealers actually hedge risk. Welcome back to the channel. If you're new here, we talk about smart investing, tools, and strategies to help you build real wealth. If you have not subscribed yet, please do. It genuinely helps this channel grow. Let's talk trade. An option is basically a contract. A call option is a bet that a stock will go up. A put option is a bet that a stock will go down. For example, if Apple is trading at $200, you could buy a $210 call option betting the stock rises. Now here's the important part. When you buy an option, someone has to sell it to you. Usually that seller is a market maker, and market makers don't want directional risk, so they hedge themselves constantly. This hedging activity is what creates many of the strange market moves you see during OpEx. To understand OpEx, you first need to understand delta. Delta measures how much an option moves when the stock moves. Think of delta like a speedometer. If an option has a delta of 0.5t and the stock rises $1, the option gains about 50 cents. But delta creates a bigger problem for market makers. Let's say thousands of traders suddenly buy call options on a stock. The dealers who sold those calls now risk losing money if the stock rises. So what do? They buy the stock to hedge themselves. And that buying pressure can actually push the stock even higher. This is one of the hidden engines behind market rallies. Now comes the most important concept: gamma. If delta is speed, gamma is acceleration. Gamma measures how fast delta changes, and near expiration, gamma becomes explosive. This means even tiny stock moves force dealers to hedge aggressively. If the market rises, dealers may need to buy more stock. If the market falls, dealers may need to sell more stock. This creates chain reactions that can cause violent rallies, sharp crashes, fake breakouts, and sudden reversals. There are two major environments traders watch: positive gamma and negative gamma. In positive gamma, dealers sell strength and buy weakness. This acts like shock absorbers for the market. Volatility stays calmer. But in negative gamma, dealers do the opposite. They buy as markets rise and sell as markets fall. That creates feedback loops. Think gasoline on fire. This is where markets suddenly become extremely volatile. Another strange OpEx phenomenon is called strike pinning. Stocks often get pulled toward major option strike prices, especially big round numbers or strikes with huge open interest. Why? Because dealers hedge heavily around these levels. As prices move, they buy dips and sell rallies, which creates a rubber band effect. This is why stocks sometimes close exactly near important strikes on expiration day. This is where many retail traders get trapped. They see a breakout, huge volume, fast price movement, and assume smart money knows something. But often, it's just mechanical hedging, not real investing. That's why OpEx price action can be extremely deceptive. A stock may rally with terrible news or crash despite strong earnings, because derivatives flow temporarily becomes more important than fundamentals. Here's the most important thing professional traders watch: not just expiration itself, but what happens after expiration. Because once options expire, many dealer hedges disappear instantly. Billions of dollars worth of stock hedges, ETF hedges, futures hedges suddenly get unwound. This is why markets can completely change direction after OpEx. Sometimes Monday reveals the real trend once all the options pressure disappears. So next time markets behave irrationally on a Friday, Remember, it may not be news, it may not be investors, it may actually be dealer hedging, gamma exposure, and options expiration flows controlling price action. And once you understand how these hidden mechanics work, you start thinking less like retail and more like Wall Street. If you enjoyed this breakdown, hit the like button, subscribe, and comment below if you want a full video next on gamma squeezes, 0DTE options, or how market makers actually make money.